I spent the last year working with a very broad network of financial services professionals. Obviously, I have a long history in the industry, working on whether or not investing in Deutsche Bank made sense. And quite frankly, for 8 or 9 months of that year, I couldn't get there. And
because the stock was too high still.
Partially value, but actually more importantly, the strategic direction and the leadership at the top of the firm. And with the change in management and the direction that Christian and the team are now setting, I think it is the most compelling risk-reward opportunity in financial services today, and I'm happy to talk about that.
How much of that, though, is because it is potentially just oversold? Because the bar is so much lower than it used to be. Is that part of the argument here?
Well, so part of the argument certainly is the starting point today that the company trades at 1/3 of its tangible book value. So most European banks trade at about 1 times tangible book, slightly below. U.S. banks trade at about 1.4 times tangible book. So you start from the perspective that this is cheap on any measure.
Right.
And then you have to ask yourself the question, why, right? And the first question you ask for a financial services firm is book really book? And what's happened over the last 7 years, and this is really what John Cryan did during his period of time, is they took 32 billion euros of charges, 15 in litigation, 17 writing off bad assets. They raised almost 30 billion euro of new equity. And when I announced my investment yesterday, the entire market value for Deutsche Bank was 18 billion euro, right? And so you start from the proposition, is the balance sheet good? And the answer is, after 7 years of pain, you've got a highly liquid, well-capitalized, I would argue, conservatively marked balance sheet. So that's the starting point.
Let me ask you this. Does this company have to remain independent? I want to play a quote to you. This is from your former boss, Jamie Dimon, was asked
yesterday,
yesterday, was asked whether JP Morgan would ever want to buy Deutsche Bank. This is what he had to say. He said it would not make any sense if you only buy a company just to consolidate it. It's almost impossible to do without killing the patient. I don't know if that is a commentary so much on Deutsche Bank in terms of your own investment, but is this a company you think will ultimately get bought out by somebody else?
So the real story for Deutsche Bank is the second part, which is this is the most compelling self-help story in financial services, right? So you start off with a very clean balance sheet, but the company's not earning any money, right? And so what's been important in our investment thesis is the new CEO, Christian Saving, right? Christian has articulated, I think, a compelling plan to return this bank to sustainable profitability. So the value opportunity for investors today is all about self-help. Ultimately, Andrew, is there further consolidation in financial services? Almost certainly. Is there further consolidation in financial services in Europe and in Germany specifically? Probably, right? But there is so much value creation that is available to the company and its shareholders just by fixing their businesses. That's the most important thing the company has to do.